Welcome to vTalkInsight Allocator's Lens Daily for February 6th, 2026. Market volatility is picking up. A tech and software drawdown is colliding with an unprecedented wave of AI spending. And bond curves are steepening just as crypto and precious metals endure a forceful deleveraging. For cross-asset allocators, the key today is how these moves link together across equities, rates, credit, currencies, and commodities. So let's start with equities. In equities, risk is again concentrated in the tech complex, where a powerful deleveraging is driving both volatility and factor rotation. A sharp sell-off in software has erased around $1 trillion of market value in a week, and the weakness has broadened from software into semiconductors, with names like AMD and NVIDIA also coming under pressure. Margin calls and higher margin requirements are forcing investors out of crowded, high-momentum trades across software stocks, gold, silver, and Bitcoin, turning what began as a sector story into a cross-asset unwind. That stress shows up in equity volatility indices, which have moved from the mid-teens to just above the low 20s over the last several sessions, even as headline indices have only begun to reflect the shift in risk appetite. At the same time, there's a clear rotation under the surface from growth into value and more traditional sectors. Recent tech weakness, especially in software, has sparked selling in high multiple names, while investors look more favorably on stable cash flow businesses, including financials and some cyclicals. Macro data are adding to the unease. Rising U.S. jobless claims, combined with the largest January challenger job cuts since 2009, driven in part by layoffs at Amazon, UPS, and Dell, are reinforcing the sense that the labor market is losing momentum. Those cuts signal growing corporate caution on the economic outlook, which feeds into expectations for earnings downgrades, particularly in more cyclical and growth-exposed corners of the market. A major tension for equity allocators is the contrast between extraordinary AI investment and increasingly skeptical price action. Across the hyperscalers, AI-driven capital expenditure is projected to exceed $400 billion by 2026, roughly 5 times the level of just 3 years ago, with around 80% of these massive budgets now tied to AI initiatives. Alphabet alone plans to spend up to $185 billion this year, more than in the previous 3 years combined, and about half of that is earmarked for AI servers. Yet markets are no longer rewarding this scale of spending automatically. Amazon's 2026 Capex guidance of $200 billion, far above prior expectations, triggered a double-digit drop in its share price, showing that investors now demand clearer visibility on returns before endorsing large checkbooks. Concerns about which companies actually own proprietary data, and which are simply aggregators or depend on external sources, are driving a reassessment of business model durability and long-term equity value. Offsetting that caution is strong evidence that parts of the AI ecosystem are already monetizing this Capex surge. Alphabet reported nearly $97 billion of fourth-quarter sales ex-partner payouts, beating estimates, with revenue for partner-built AI solutions up almost 300% year-on-year and top software partner commitments multiplying more than 16-fold. AI infrastructure suppliers from Broadcom to Marvell and Applied Materials are seeing demand absorb every new data center that comes online, and NVIDIA retains a dominant competitive position due to its software ecosystem and flexibility, even as some customers develop in-house chips. Within software, the sell-off looks increasingly indiscriminate. Many public SaaS companies have pushed through price increases. Incumbents such as CrowdStrike and ServiceNow appear well-placed to embed AI into existing workflows, and depressed valuations plus strong cash flows are expected to attract both private equity and strategic buyers, with names like Snowflake frequently cited. Larger platforms like Alphabet, Microsoft, Salesforce, and Apple are described as fundamentally resilient, supported by robust cash generation and significant AI monetization optionality across installed user bases. For allocators, that leaves a highly dispersed equity landscape, where headline volatility is being driven by a combination of macro labor worries, leverage unwinds, and a valuation reset in long-duration tech, while the underlying AI investment thesis and certain cash-generative franchises remain intact. Turning to rates, bond markets are signaling a very different mix of risks, with curves steepening as long-end yields face persistent upward pressure. In the United States, the 2-year Treasury yield has been drifting lower toward the mid-3% area, while the 30-year has pushed up toward just under 5%, reflecting expectations for easier policy at the front end, but higher-term premia further out. A global surge in government bond issuance from the U.S., Japan, and Germany, alongside a U.S. Treasury refunding strategy tilted toward longer maturities, is making it hard for long-dated yields to fall, even as short rates look more anchored. In the UK, political uncertainty and concerns over fiscal deficits are steepening the gilt curve, with 10-year yields climbing above 4.5% and long-dated spreads reaching their widest levels in several years. Central banks in Europe are adding nuance rather than clear relief. The Bank of England is widely expected either to keep rates unchanged for now or to move cautiously toward cuts later, as inflation is projected to reach target by late spring or summer, but wage and labor market data remain uneasy. The European Central Bank is in a data-dependent holding pattern, with inflation near target, euro strength complicating export competitiveness, and geopolitical trade risks all arguing for caution. Market participants broadly expect the ECB to keep policy rates steady through this year and next, which, combined with rising global issuance, supports the idea of further yield curve steepening rather than a synchronized rally. For cross-asset portfolios, higher long-term real yields increase the hurdle rate for long-duration equities and private assets, while creating a more supportive carry backdrop for high-quality credit, at least as long as growth holds. In credit, the picture is more resilient on the public side, especially for large-cap tech issuers and European banks. Investor demand for Oracle's recent bond deal exceeded the offering size by about 5 times, underscoring strong appetite for high-grade technology credit even as equity investors question valuations. Credit analysts remain constructive on large-cap tech balance sheets, citing strong cash flows and limited concern over leverage, which contrasts with the derating seen in their equity valuations. European banks are also posting impressive numbers. Some are guiding to return on equity north of 20% through 2026, while asset quality remains solid. BNP Paribas, for example, delivered a 28% year-on-year profit increase in the fourth quarter, beat expectations, raised its midterm targets, and attributes part of its turnaround to AI-driven cost reductions, with a €600 million cost-saving plan in train. Current volatility is even supporting banks trading and hedging franchises, and abundant liquidity plus post-crisis regulation are expected to limit near-term financing stress for the sector. The more fragile spot in credit lies in private markets and their intersection with technology. Private equity, private credit, and private debt are drawing increased scrutiny as public market swings revive questions about fair value marks, leverage, and exit timing. Despite continued growth in private credit as a diversification tool, the compensation for risk is described as the weakest in years, and some managers with heavy software exposure are already experiencing meaningful drawdowns. Private credit platforms now play a key role in financing long-lived infrastructure, including data centers for AI, which introduces hard-to-price tail risk if AI economics disappoint or if the current software correction deepens. Listed private equity and credit managers, such as KKR, Ares, and Blackstone, still report strong double-digit earnings and inflows. Yet their own shares lag due to concerns over transparency and a vintage risk embedded in 2021 and 2022 tech leverage buyouts. One manager, Blue Owl, has seen its stock fall roughly 50% over the past year versus S&P gains, largely because of its perceived tech exposure, highlighting how equity markets are already marking down parts of the private ecosystem even as the underlying credit cycle remains benign. In currencies, major pairs remain range-bound, but the forces underneath are shifting. The Bloomberg Dollar Spot Index has strung together its first back-to-back gains in nearly a month, yet it still sits near its weakest level in almost 4 years, capturing a tug-of-war between structural softness and cyclical support. On one side, political risk and a perceived preference by U.S. policymakers for a weaker dollar lean against sustained appreciation. On the other, stronger U.S. data surprises, expansive fiscal policy, and a still restrictive monetary stance are seen as catalysts for a near-term dollar rebound. The result is tight trading ranges, particularly in euro-dollar, which is also constrained by the ECB's reluctance to pre-commit on future cuts and by worries that euro appreciation above roughly 1.2 could further weaken exports and entrench low inflation. In the UK, persistent inflation and expectations that rates will stay relatively high for longer may support sterling. But that same rate backdrop poses challenges for domestic equities compared with last year, when dollar weakness was a more powerful tailwind. Crypto assets are behaving more like high beta risk proxies than like safe havens in this environment. Bitcoin has lost more than $1 trillion in market value since its October peak, and U.S.-listed Bitcoin funds have seen over $272 million of outflows this week alone. Major cryptocurrencies, including Bitcoin and Ethereum, are underperforming traditional safe havens such as gold and silver, undermining the digital gold narrative and contributing to a broader crisis of confidence in the sector. Concentration risk is a concern, with MicroStrategy controlling roughly 3% of outstanding Bitcoin. Any forced liquidation to meet liquidity needs or repay debt could materially hit prices and sentiment. Regulatory progress is mixed. A crypto market structure bill has advanced out of committee. There is active debate over whether intermediaries can pay interest on stablecoins without threatening bank deposits, and policymakers are calling for a better funded, fully staffed CFTC ahead of expanded oversight. At the same time, market stress is likely to accelerate consolidation among smaller exchanges with stagnant revenues, even as institutional adoption continues through compliant platforms and new bank-backed stablecoins. Commodities round out the picture with their own form of turbulence, especially in precious metals. Gold and silver had previously surged at an unusually rapid pace despite historically low equity volatility, a combination not seen before, suggesting that metals were being used as both hedges and speculative vehicles. That move has now sharply reversed. Silver is down more than 11%, wiping out earlier gains, and its volatility is approaching record highs. Silver and gold have both given background, and silver in particular is increasingly viewed as a barometer for risk appetite in retail-dominated markets, with the potential for spillovers into other crowd-owned assets if selling accelerates. Importantly, the same deleveraging forces hitting software, crypto, and precious metals are linked through increased margin requirements and the unwinding of speculative positions, underscoring how leverage can transmit shocks across seemingly distinct asset classes. In energy and industrials, the signals are more mixed. Oil prices remain up roughly 12% year-to-date, even after a recent drop of about 2%, reflecting a sizable geopolitical risk premium tied to U.S.-Iran tensions and explicit warnings that any conflict could disrupt the Strait of Hormuz and regional infrastructure. Negotiations appear stuck, and while markets generally expect U.S. responses to remain limited, the risk of miscalculation keeps a floor under energy prices and supports related equities. Yet basic resources and mining stocks, particularly in Europe, are under notable pressure as copper, gold, and especially silver prices fall, weighing on cyclical exposure. Shipping faces an entirely different challenge. Global trade is expected to grow 2 to 4%, but vessel capacity could rise 5 to 6% in 2025, plus another 4 to 5% as Red Sea routes reopen. Maersk is resuming permanent services through the Red Sea, guiding underlying EBITDA down from about $9 billion to as low as $7 billion, and implementing a new network forecast to save nearly $1 billion annually. That combination points to overcapacity and downward pressure on freight rates, which may help cap goods inflation but will squeeze margins in the sector. Within energy equities, Shell illustrates the cross-currents. A year-on-year net income decline of 11% driven by weaker prices and trading sits alongside strong free cash flow yields, a $3.5 billion buyback, a target of 10% annual free cash flow per share growth through 2030, and a solid balance sheet with low net debt, while its long-term strategy leans on integrated gas and marketing growth. Stepping back, the cross-asset message is one of rising volatility, sharper dispersion, and more visible linkages across markets. Equities are absorbing a powerful tech-led deleveraging just as AI capital spending reaches unprecedented levels and labor market data soften, pushing investors to question how much growth and duration risk they want to carry. Rates markets point to higher term premia and steepening curves, driven by heavy long-end issuance and cautious central banks, which raises the discount rate applied to long-duration cash flows even if front-end policy starts to ease. Public credit, particularly for large-cap tech and European banks, still looks robust, while private credit and private equity structures with heavy software exposure face growing scrutiny over valuations, transparency, and leverage. In FX, a structurally softer but cyclically supported dollar leaves majors in tight ranges, even as crypto assets endure a confidence shock and behave less like diversifiers and more like high beta risk trades. Commodities show both sides of the coin. Precious metals and crypto linked by leverage-driven swings, oil supported by geopolitical risk, and shipping and miners adjusting to overcapacity and softer prices. For multi-asset allocators, key things to monitor now are the path of AI-related earnings versus Capex, the persistence of yield curve steepening, early signs of stress in private credit tied to software, and whether volatility in silver, crypto, and shipping signals broader shifts in liquidity and risk appetite. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.